So if you happen to glance at your portfolio yesterday, specifically at AST Space Mobile, you probably had a bit of a shock.
A bit of a shock is putting it mildly. It was a pretty aggressive dip.
We saw the stock drop nearly 12% in just one session. By the close, it was down to $85.73.
Yeah, and considering the run it's been on, losing almost $12 a share in a few hours, I mean, that creates panic.
It looked ugly on the surface, for sure. Ask the real question. Is this drop a sign of some, fundamental failure? Is the whole project falling apart?
Or, on the flip side, did one single analyst just create this strategic entry point of the year?
Okay, let's unpack this. We need to find the signal in all of this noise.
And that's the tension we're going to resolve for you. We've gone through the analysis report, and we're going to break it down into 3 key areas.
Okay, so what are they?
First, the bearish arguments, what actually caused the sell-off. Then, the bullish counter-arguments, which suggest nothing has really changed.
And finally,
we'll get into the technicals. We'll look at the chart and define that critical buy zone that people are talking about around the $80 to $85 level.
Perfect. Let's start with the catalyst then, the cause of all this chaos. Because it's really important to understand that this dip was not from a bad earnings report.
No, and it wasn't a failed satellite launch or some kind of operational disaster either.
It was driven, and this is the crazy part, solely by the opinion of one investment bank.
That's right. The entire market flush was because Scotiabank cut the stock to sector underperform.
Which is basically their version of a sell rating, right?
For all intents and purposes, yes. And they weren't just cautious about it. They issued a really, really aggressive price target cut.
I mean, they didn't just trim it. They basically took an axe to it. Scotiabank put a $45 price target on the stock.
$45. When you see a number like that from a major bank, it's guaranteed to cause a panic sell, especially for a stock like ASTS.
A name that's so driven by future potential and momentum.
Right. And if you look at the core bear argument in the analysis report, it all just boils down to one thing: pacing.
They're just saying ASTS is moving too slowly.
Exactly. Too slow to justify its valuation. The specific delay they pointed to was the company shifting to launching just one satellite in 2025.
Instead of the 50 they had promised, or at least projected in earlier timelines.
Right. And on paper, that sounds, terrifying. 1 versus 50. It sounds like the project is completely stalled out.
It's a huge discrepancy.
Yeah.
But the analysis report digs into that, doesn't it? It questions that baseline.
It does. It raises the question of whether that 50 satellite promise was ever realistic to begin with.
I mean, space is hard. We hear that all the time.
It's incredibly hard. Delays are just part of the game in the aerospace industry, especially when you're doing something for the first time. The market panic seemed to treat this as brand new information.
So the argument is that Scotiabank was late to the party, pricing in a risk that was already pretty obvious to anyone following the sector closely.
Precisely. They were judging it against a perfect rollout schedule that almost never happens. And when reality hit, the market dumped over 24 million shares in one session.
And that was made worse by their second concern, the cash burn.
Yes, the other prong of the attack. They brought up worries about cash burn continuing, maybe even until 2028.
Because if the deployment schedule slips that much, you have to ask if the company can afford the delay, right?
Exactly. The report suggests the market reacted so violently because that downgrade forced everyone to rethink the timeline to profitability. A longer timeline means a higher risk profile.
So we have the bear case laid out, slow deployment and increased cash burn risk, but that's only half the picture.
Not even close, no.
Here's where it gets really interesting. Let's pivot to the rebuttal. Because the bull case basically dismisses all of this as short-term noise.
Right. This is where we need to look beyond the next quarter and focus on the foundation of the company, which, hasn't changed at all. The bullish argument has 3 main pillars.
And the first one, which I think is probably the most important, is that the partners are still rock solid.
Absolutely critical. The analysis points to continued strong partnerships with huge companies. We're talking AT&T, Verizon, Vodafone, even Google.
These aren't just like handshake deals. They are deep strategic partnerships.
And AT&T's involvement specifically tells you everything you need to know about the demand. These giants are invested because there is no alternative.
And that's the technological advantage, isn't it? The analysis says ASTS is the only one building a true broadband network for standard phones.
Can you break that down a little more? Because people hear Starlink direct-to-cell and they might think it's the same thing.
It's a great question, and the distinction is everything. It really comes down to usability.
So what can the other guys do?
Other direct-to-cell tech right now is for, basic stuff, emergency texts, maybe some very low bandwidth data.
Okay, so not watching videos or anything.
Not at all. ASTS is aiming to deliver actual mobile broadband speed like 4G or 5G to the phone that's already in your pocket. No special hardware needed.
Which is the game changer. It means partners like AT&T can just offer seamless service to their existing customers.
Exactly. And if that tech advantage holds, a delay of a few months is just not a good enough reason for them to walk away. That brings us to the second counter-argument. The growth story.
Right, the explosive trajectory versus the small revenue numbers Scotiabank is so worried about.
Yes, the current revenue is small, only about $14 million. But the growth stat is what matters here.
It's up 12,239% year over year.
1,239%. Now, it's from a small base, sure, but that shows the curve is steep.
But this is where you get that classic Wall Street disconnect, right? The analysis really highlights this. An analyst at a big bank cares about the next 3 months. They need to see results to justify their quarterly targets.
And meanwhile, patient investors, the smart money, are looking 3 to 5 years out. They're betting on the total market.
Exactly. So for them, a 6-month or even a 1-year delay in a project that will take a decade to build out is, like the report says, just noise.
Because you're not investing in next quarter's earnings. You're investing in the idea of providing mobile broadband to the 3.2 billion people who don't have it.
That's the trillion-dollar opportunity they keep talking about. It's at that massive untapped market.
Okay, so that just leaves the third pillar, which is tackling that cash burn fear head on.
Yes, the fear of insolvency. While the bears are focused on how long the company will be burning cash,
the bulls are pointing to how much cash they have right now.
They have $1.2 billion in cash on hand. And if you look at their recent spending, that $1 billion gives them a runway well into 2027.
Maybe even 2028, depending on how fast they scale production.
So yes, the cash burn might extend to 2028 like the analysts feared, but the company has the money to cover it. The immediate risk is just mitigated.
It buys them time, and time is the most valuable thing you can have in space development.
It protects the assets and the partnerships from any short-term financial panic.
Okay, so the fundamentals seem solid despite the delay. But for traders, this price drop is a completely different story, isn't it? It's all about the chart.
Absolutely. Now we shift from the fundamentals to market psychology. From valuation to the specific risk-reward setup this dip created.
The stock closed at $85.73. But what happened right after the bell is what's really telling.
It immediately started turning green in after-hours trading.
That is the definition of buyers stepping in. It wasn't a total capitulation, it was an absorption event.
It's a huge signal that big money, both institutions and retail, were just waiting for a dip like this. The stock is now testing a really critical level.
And the analysis calls this level the massive psychological floor. That support zone between $80 and $85. Why there?
It's historical. That range has been a major accumulation zone in the past. Every time the stock has pulled back 15 to 20% in previous rallies, buyers have just scooped it up.
So it's a heavily defended area.
A very heavily defended. It's where a lot of long-term holders first bought in, so they're willing to add to their positions there. You see volume spike when it hits that zone.
And technically speaking, the stock was kind of getting ahead of itself before this drop, wasn't it?
Oh yeah, it was overbought. It was trading way above its key moving averages, which is often a sign that a pullback is due.
So this drop just reset things.
It cooled everything off. The RSI, the Relative Strength Index, it dropped significantly. It's out of that danger zone now, which makes it a much more attractive entry from a technical standpoint.
So the overall technical takeaway here is that the downgrade, ironically, did something necessary.
It shook out the weak hands. The day traders who were just in it for a quick buck. This kind of volatility clears the deck,
setting the stage for a potential rebound, according to the analysis, fueled by more patient capital coming in at a discount.
So what does this all mean for you, the listener?
At the end of the day, it really just hinges on your time horizon, doesn't it?
Completely. Are you focused on the short-term delay and that scary $45 price target from Scotiabank?
Or are you focused on the multi-year trillion-dollar opportunity that's backed by these huge, sticky partnerships?
The source analyst who wrote the report is very clear on where they stand.
Right. They state they are not selling a single share. In fact, they're looking to add more if the price gets closer to that $80 support level. It's that discount coupon idea.
Yeah, and the whole analysis is really wrapped up in that classic market quote they included.
The stock market is a device for transferring money from the impatient to the patient.
That's the one. This event was a perfect stress test for investor patience.
A strong reminder that if you're going to bet on this kind of disruptive tech, you need conviction and you need to be able to stomach the volatility.
Absolutely. And that leaves us with one final provocative thought for you to chew on.
Go on.
Given that the whole bull case rests on ASTS building a truly superior broadband network for standard phones, not just a messaging service, and given how complex that is, does that complexity mean that the investment timeline has to be fundamentally different? And if so, does that automatically make any short-term analysts concerned about deployment speed sort of, well, misplaced? It's really a question of speed versus scope.